The ultimate guide to surviving a stock market crash. Are you worried about the stock market crashing? While stock market crashes can be scary, it is important to remember that they are a normal part of the market cycle. To help you prepare and protect your wealth, this post is the ultimate guide to surviving a stock market crash. Here, you will find important strategies to protect your investments, as well as helpful tips on how to keep your finances in check in the event of a crash. So, if you're feeling anxious about the stock market, watch on for the essential knowledge you need to survive a stock market crash. What causes a stock market crash? The causes of a stock market crash can be complex and varied, but understanding the factors that contribute to these events can help investors better navigate the volatile nature of the market. One major cause of a stock market crash is investor panic and fear. When investors become anxious about the state of the economy or the outlook for specific companies, they may rush to sell their shares, creating a rapid and dramatic decline in stock prices. Additionally, economic factors such as a recession, inflation, and high interest rates can also contribute to a market crash. Political instability or major geopolitical events can also have a significant impact on stock markets. Market crashes can also be triggered by speculative bubbles or excessive speculation in certain sectors, leading to an unsustainable increase in stock prices that eventually burst. Understanding these potential causes can help investors prepare for and potentially mitigate the impacts of a market crash on their portfolios. Stay tuned for more insights on surviving a stock market crash in the following sections. Signs of a market downturn. A market downturn or a decline in stock prices can be a precursor to a full-blown stock market crash. As an investor, it is crucial to recognize the signs of a market downturn to protect your investments and minimize potential losses. So, what are some signs to look out for? One common sign of a market downturn is an increase in market volatility. When the stock market becomes more volatile, with large price swings and fluctuations, it may indicate that investors are feeling uncertain or anxious about the market's future direction. Pay attention to news headlines and market indicators that track volatility, such as the VIX index, to gauge the overall sentiment of investors. Another warning sign is a decrease in corporate earnings. When companies start reporting lower than expected profits or revenue, it can lead to a sell-off in their stocks. Poor corporate performance can be an indication that the broader economy is slowing down, which may eventually lead to a market downturn. Furthermore, keep an eye on economic indicators like unemployment rates, GDP growth, and interest rates. If these indicators start showing negative trends, it could signal an impending market downturn. Remember, market downturns can be challenging to predict accurately, but by staying informed and watching out for these signs, you can be better prepared to protect your investments and navigate the uncertainties of the stock market. Protecting your portfolio before the crash. Protecting your portfolio before a stock market crash is a crucial step in safeguarding your investments and minimizing potential losses. While it is impossible to predict when a crash will occur, there are proactive strategies you can implement to mitigate the impact on your portfolio. Diversification is one key strategy to protect your portfolio. By spreading your investments across different asset classes, sectors, and geographic regions, you can reduce your exposure to any single investment or market segment. This way, if one area of the market experiences a downturn, you will have other investments that may perform well and offset potential losses. Another strategy is to regularly rebalance your portfolio. This involves periodically reviewing your investments and adjusting their allocation to maintain your desired risk profile. Rebalancing helps to ensure that you're not overly exposed to any single investment or asset class, which can help protect your portfolio from severe market declines. It is also important to have a well-defined investment strategy and stick to it, even in times of market uncertainty. This means establishing clear investment goals, understanding your risk tolerance, and diversifying your investments accordingly. By having a disciplined approach to investing, you are less likely to make emotional knee-jerk reactions to market fluctuations. Lastly, staying informed and regularly reviewing your portfolio are crucial steps in protecting your investments. Keep up to date with market news, economic indicators, and company performance. By being proactive and informed, you can make better informed decisions and take action to protect your portfolio before a crash occurs. Remember, protecting your portfolio before a crash requires a proactive approach. By diversifying your investments, regularly rebalancing your portfolio, sticking to your investment strategy, and staying informed, you can increase the resilience of your portfolio and better navigate the uncertainties of the stock market. What to do during a crash? When a stock market crash occurs, it's easy to panic and make impulsive decisions. However, it's important to stay calm and focused on protecting your investments. So, what should you do during a crash? First, resist the urge to sell everything. While it may be tempting to cut your losses and exit the market completely, selling during a crash often leads to significant losses. Instead, focus on holding on to quality investments that have the potential to recover in the long term. Next, consider investing in defensive sectors. During a market downturn, certain industries tend to perform better than others. Defensive sectors like consumer staples, healthcare, and utilities typically fare well because their products and services are in demand regardless of the state of the economy. Additionally, keep a close eye on market trends and news. Monitor key indicators and stay informed about the overall sentiment of investors. This information can help you make more informed decisions about when to buy or sell. Lastly, considering using stop-loss orders. These orders automatically sell a stock if it reaches a predetermined price, helping you limit your losses and protect your portfolio. Remember, staying calm, focusing on quality investments, diversifying, and staying informed are crucial steps to take during a market crash. By following these strategies, you can navigate the storm and potentially emerge in a stronger financial position. Opportunities during and after a crash. During and after a stock market crash, there are actually opportunities for savvy investors to take advantage of. While it may seem counterintuitive to think about investing during a market downturn, history has shown that there can be potential benefits. One opportunity is to consider buying quality stocks at discounted prices. When the market crashes, even fundamentally strong companies may see their stock prices plummet. This presents an opportunity to scoop up these stocks at a lower price and potentially reap significant gains when the market eventually rebounds. Another opportunity lies in diversifying your portfolio further. As certain sectors may be hit harder during a crash, you can consider investing in industries that tend to perform well in uncertain times, such as healthcare, technology, or renewable energy. By strategically diversifying your investments, you can position yourself to potentially benefit from the recovery of these sectors. Furthermore, if you have cash on hand during a crash, it can be an opportunity to deploy it strategically. Look for undervalued assets, or even consider investing in real estate or other alternative investments that may offer attractive returns. Ultimately, the key to finding opportunities during and after a crash is to approach investing with a long-term perspective. While it may be a bumpy road, history has shown that markets eventually recover and provide opportunities for growth. So keep a watchful eye, do your research, and be prepared to seize the opportunities that present themselves. Rebuilding your portfolio after a crash. After enduring a stock market crash, it's time to pick up the pieces and start rebuilding your portfolio. The first step is to assess the damage and determine which investments survived relatively unscathed. These resilient investments can form the foundation for your portfolio reconstruction. Next, it's important to evaluate the sectors and industries that showed resilience during the crash. Look for areas that demonstrated stability and growth potential. By strategically reallocating your resources to these sectors, you can position yourself for future success. Consider taking advantage of any tax loss harvesting opportunities that may arise from the crash. Selling investments at a loss can help offset any capital gains and reduce your tax liability. Rebuilding your portfolio after a crash also presents an opportunity to reassess your risk tolerance and investment strategy. Take the time to redefine your goals and create a diversified portfolio that aligns with your new risk tolerance level. Lastly, stay informed and continue to monitor the market. Look for emerging trends and opportunities that can help guide your rebuilding efforts. Remember, rebuilding your portfolio after a crash requires patience and a long-term perspective. By learning from the past and adapting your strategy, you can rebuild a resilient portfolio that can weather future storms. So that's all for it for today. I hope you all liked this video. If you enjoyed this video, don't forget to give it a thumbs up and subscribe to our channel.